Hey guys, Sean Pruitt here, president of Kingdom Explorations. A lot of things happening in the oil industry, and the news that I'm seeing over and over again is oil prices are crashing. Now, oil has dropped from 80 something dollars a barrel down to 72 dollars a barrel. Is that a crash? No, it is not, but it has fallen significantly. And now here's the thing. Okay, when you have somebody like Janet Yellen going on the news outlets saying by June we might run out of money, that's going to cause everybody to freak out, is it not? And so here's the deal. The Fed's job is to protect the dollar. That's the only thing they care about. And the only way to do that is by not allowing inflation. That's why they increase the interest rates hikes. They reduce the amount of capital out there, and it reduces the value of various items. Okay. And so that reduces inflation. But one of the biggest contributors to inflation is the price of a barrel of oil, is the price of gasoline. And so the only way to control the price of energy is reducing the price of a barrel of oil. So the Fed's job is to protect the dollar. That's the only thing that matters. So they also have to reduce the price of a barrel of crude in order to prevent the inflation of the almighty dollar. That's the only thing they care about. The Federal Reserve is the most powerful entity. It's not a U.S. entity. It's not American, guys. And their only job is to protect the dollar at the expense of a commodity like crude. Crude is the number one driving factor of inflation. If the price of a barrel of crude goes up too high, the cost of energy prices go up, and the discretionary capital for Americans is gone. Therefore, it causes major inflation, major recession, destroying the Federal Reserve. So here's the deal. Janet Yellen saying things like that is reducing the price of a barrel of crude. Recession fears reduces the price of a barrel of crude. Now, here's the thing. The price of a barrel of crude is not fundamental. The fundamental price should be much higher. It is purely based upon I'm talking about deep recession fears. That's what I'm hearing from other analysts, okay? The price of a barrel of oil is already priced in a deep recession fear, which tells me we're not going to see significant crashes in the price of a barrel of crude. We might see another drop down to the 60s. That is very possible because there's still some moves that they're making until they figure out the debt ceiling, until they get these things under control. We might see oil prices dropping. But here's the thing. Oil, right now, it's not fundamental. And the lower oil prices stay in a non-fundamental price, the higher prices will go in the end because it reduces the amount of capital spending for shale oil. It reduces the amount of capital spending for Russia, for Saudi Arabia, for every country in the world. It reduces the amount of investors involving themselves in oil and gas. So that's why all these investors are shorting right now. Okay. In addition to that, when the price of a barrel of crude is lower, all of a sudden, people start buying even more oil, okay? We're seeing our oil inventory stocks drop significantly, okay? Iran seizes second oil tanker in the Arabian Gulf. Now, in the past, that would have caused oil prices to go up $5 a barrel, but it didn't. Why? Because oil is not in a fundamental price right now with all these recession fears, okay? So the fact that we lost the effect of OPEC, okay? We haven't lost the effect of OPEC. We haven't lost the effect of what's happening in Iran. The problem is oil prices are priced in a deep recession. It's non-fundamental, which tells me that when things start to clean up with the feds, you're going to see that price come back significantly. But if it doesn't clean up, you're going to see it's like that slingshot. The further it goes back, the further it's going to go. The longer we stay in this place of a non-fundamental priced barrel of crude, the higher prices will go in the end, because this is really damaging the ability to increase output. Okay. And so here's the thing. Crude stocks continue to decline. In fact, the last 2 decades, over the last 20 years, only 2 times in the last 20 years have crude stocks dropped in the month of April. Okay, and the oil market is tightening in the background, even without the effect of OPEC. Okay, and so don't give because OPEC reduces the amount of output. And people just assume, oh, well, OPEC is just manipulating markets. No, it's because of demand. Okay. And so when you reduce the stockpile of crude, it means that there's a higher demand than what we're producing right now. Okay. So fundamentally speaking, oil prices should be much higher. And that tells the truth about the situation. The price of a barrel of crude isn't the truth. Okay. And so here's the thing. The SPR is currently still doing a mandatory release. So they're releasing oil into the market. Okay. That's going to come to an end. And they're not going to be buying more oil, possibly until the last quarter, because after they sell the oil, they're going to have to do some maintenance with the facilities, and it won't be available to be able to add more oil to that till the end of the quarter. And here, and the thing is, based on some research I did from an analyst, Saudi Arabia needs minimum $80 a barrel just to operate. They need a minimum of $80 a barrel. OPEC has the power to increase prices any moment. If they came on the news and went on record and said, hey, we're reducing oil output by another 2 million barrels a day, oil prices would stabilize instantly. They would go up $5 to $10 to $20 a barrel. Who knows? Okay. They have that ability, okay, to do that. All right. And so in the event that things did get a little nasty out there in the economy, they have the ability to keep prices strong. So I have all the confidence in the world that we're going to see higher prices at the end of the year after this mess gets cleaned up. The markets are tightening even more every single day. Let's look at some news here. And if you look at what's happening with Shale, it says peak U.S. shale to raise prices at the pump. Now, the thing about shale oil and gas, they are saying things that are basically justifying what they're going through. The truth is that shale is not profitable right now. Okay, they are in tier 2 assets, which means they've already developed all their top producing assets. Now they have to go to the secondary, less quality assets where they're spending more money for less oil. Okay. Shell executives say that peak Permian production will occur this decade. This could lead to structurally higher prices at the pumps as consumers will feel the pinch from U.S. shale losing global market share at the expense of OPEC, which is only set to increase its control over global oil supply. The new priorities of the Shale patch, capital discipline, and a focus on returns to shareholders and debt repayments, have coupled with supply chain constraints and cost inflation to drag down U.S. oil production growth in recent months. Now, here's the deal. They are blaming they're blaming supply chain constraints. They're blaming OPEC, and they are giving the excuse like we're focused on return to shareholders and capital discipline. In other words, we're going to spend less money to develop oil and gas so we could give more money to the investors. Okay. And we're having supply chain problems. Okay. Because of COVID and all these things. Okay. They are having an issue with hiring people. They're having issue with supply chains, getting equipment. I mean, I've seen some issues on some other deals I'm involved in. And so bottom line, the Shell company is telling you, listen, we're not going to be spending as much money on oil because we're focusing on returns. Now, if I was a big multi-billion-dollar oil company like Shell, Chevron, Texaco, I would be reducing the amount of capital I'm spending right now. Because if you go and spend a ton of money like you did in 2012, 2013, or whatever, I don't even know if they have the capital because the banks aren't lending and so many investors are fleeing the oil market. And see, that's another thing. They're justifying the fact that they have less capital to spend. But here's the thing. If they go out and spend billions and billions of dollars to develop their second tier assets, they're going to have to show the world like, look, it is not near as profitable as we thought it would be. Because here's the deal. And there was a study, they did a study for 35 different oil companies. And on average, they only return 85 for shale, just for fracking wells, these big non-conventional oil wells. 85% of the capital was returned back to partners. In other words, if you invested $1 million, you only got back $850,000. That's not a good investment. That's the average shale investment during the heydays of shale, while they were focused on tier one assets. Okay. So they would have to look even worse to the world on paper. The stock would drop. Okay. Doesn't it make more sense to do capital discipline and spend less money just reaping the benefits of old wells? They've already spent the capital on these old wells. Let them produce. Okay. That revenue could be sent to the partners. They look better on paper, do they not? In addition to that, if they increase the output, they're going to decrease the price of a barrel of crude, only reducing the value of their company. They're stuck between a rock and a hard place. Drill, baby, drill. It's going to, it's not going to be profitable because they're in tier two assets. They're going to have to be honest about what is actually happening versus being able to blame supply chain, blame OPEC, blame all the woes of the economy and all these things. So it's a smart move for them, but they're not being honest. Okay. Here's my point. Shale is done. Shale cannot save us. In the past, we were in a shale oil glut. That's why we had low oil prices under Donald Trump, because we had a shale oil glut. The markets are tightening. The crude stockpiles are declining. Okay. I want to read this article here by Yahoo News. Nonetheless, there are signs the underlying oil market is resilient. China is sucking in a flood of cargoes as domestic travel rebounds, and traders expect the country's crude purchases to remain high in the next few months. Inventories are tightening around the world and should deplete even faster as Saudi Arabia and its OPEC allies implement new supply cutbacks. That's reassuring even some of the industry's most bearish forecasters. A supply deficit is coming, which will trigger a recovery in prices. The sell-off was far greater than what the market balances are showing, namely lower inventories with the prospect of inventory draws as the Northern Hemisphere's summer unfolds, said Ed Morse at Citigroup Incorporated. The bank has held one of the most cautious price outlooks on Wall Street. Okay. Now they're right. The price of a barrel of crude dropping as much as it did, it doesn't make any sense. It doesn't make any sense right now. Oil prices, WTI, crude is almost at $69 per barrel. Brent crude is $72.80. So they are recovering. Okay. I foresee the markets are tightening. Fundamentally speaking, we're getting in better position to have higher prices each and every single day. The demand for oil is growing. If you'll watch my last video, I extrapolated because they're saying by 2050, we're going to have 10 billion people. And if you look at average demand across the board for each person, you're going to see a demand of crude 125 million barrels a day, from 100 today to 125 million barrels a day by then. Now, there was another gentleman that got online and an analyst that said, on average, oil demand increases 1% each year. Well, if you plug that number in from now until 2050, that also equals 125. So whether it's because of population growth or just simple demand growth, we're going to be at 125 barrel a day demand. Okay. Who is going to supply all the oil? For every 1 barrel of oil that we find, we're producing 3. There's not enough oil out there. We're not making major oil field discoveries. Okay. And so right now, China's demand is increasing. The American recession and the woes of that, even if we go through recession, the price of a barrel of crude is already priced in a recession, deep recession for that matter. So whether we go through a light recession or a medium recession, I think oil prices will remain strong. Okay. But the longer oil prices stay low, the longer we stay in this territory of a non-fundamental environment, in these economists and these large stocks are selling off these shorts and these longs, causing oil prices to drop because of the feds and what they're doing, which the Fed's job is to protect the dollar and to destroy the price of a barrel of crude. And every single news outlet is a parakeet preaching to the world saying, hey, we're coming into a major recession. The interest rate hikes are still coming, and it's causing people to reduce their positions in oil. So oil prices are already priced in a deep recession. Oil prices are already beat up, but fundamentally they are strong. The longer we stay in this environment, that will cause a reduction across the world to reduce the amount of oil development. We don't have enough. We're not preparing for the future of oil demand. We're putting all of our faith in one basket. Some are the basket of the green energy unicorn. Look, guys, if we don't do something now, we're going to be in a mess. Saudi Arabia, OPEC, has been warning us for years, but they are laughing all the way to the bank. All right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. If you're interested in learning more about oil and gas investing or anything like that, look at my description below. Give me a call or fill out the form. Click the link below. All right, guys, thanks.